In our first lesson about fundamentals, we will discuss what fundamental analysis actually is, how it can assist the trader, and how supply and demand set rates. So what is fundamental analysis? Fundamental analysis is the study of the economic and political forces that determine currency exchange rates. So fundamental analysis is about trying to find the fair value of a currency in terms of another currency as expressed by exchange rates. By forecasting how these forces will change and develop over the medium term, we hope to forecast how exchange rates will move. We move now to supply and demand. Typically, more demand for a good or service causes its price to increase. This is understandable, as should there be high demand for something, that would mean that the seller is able to choose the buyer and thus could choose the buyer offering the most. Less demand causes the price to decline as the options of the seller become fewer and hence is forced to sell his/her commodity at a lower price. Greater supply for something usually leads to a lower price, as in such a scenario, the buyer will be able to choose from more vendors and is expected to choose based on rationality of the vendor with a lower price. On the contrary, less supply leads to a higher price, as the options for the buyer become fewer. Please note that in the FX market, the products negotiated are identical, while we also assume that the market is efficient and information is widely spread and freely available. For example, imagine we all want the new BMW model, but it's a limited edition. Only 500 cars have been made globally, and there is high demand for it. Is the price of that car likely to be high or low? Probably the price of that car is likely to be very high, because lots of people will be chasing after a limited number of cars. Hence, the company is going to be able to set a high price for it. But what happens to the price if BMW suddenly announces they will produce another 50,000 cars of the specific model? Its price will probably decline, as more cars will become available to consumers and thus satisfy their needs. Another example, a farmer in a small village produces potatoes. He's the only one producing potatoes there, and the village is relatively isolated from civilization. In the first year, the weather was excellent. He managed to produce 1,000 kilograms, more than enough to feed the whole village. He sold every kilo of potatoes for €1 in that year. However, in the following year, the weather was rather bad. He only produced 200 kilograms. What is likely to happen to the price of every kilo as the demand for potatoes remains unchanged? Prices will probably go up. Everyone will want potatoes to eat, but there may not be enough of them to go around. So each person would be willing to pay a higher price for potatoes. Or another example, Apple has just released its brand new iPhone. What will probably happen to the price of the previous iPhone model? Most likely it will go down. Is that price change going to be due to supply or demand factors? Demand factors. Apple's cost of making the previous model did not change dramatically overnight, but the fact that people now want the new iPhone suggests there is less demand for the previous version. So overall, fundamental analysis could provide a trader with the ability to recognize the direction of supply and demand on a trading instrument, and in these lessons in particular for Forex. Whenever we have high demand, the price of a currency could rise and vice versa. In our next lesson, we will discuss various factors behind the changes on a fundamental level.